Hi, this is Randy Finney with Right Side of the Chart, and today is Thursday, April 4th, 2019. This will be a midday market update. Wanted to go over a few things. We don't have any definitive clues of which way the market's going from here right now, but we do have those near-term charts that I was focused on since yesterday, these uptrend lines on the 60-minute charts. This is NQ. There's the symbol right there, NQ. So what happened today, as I mentioned this morning, we had a breakdown in the overnight early morning session, but exactly what you don't want to see to confirm it, and that is it was a very, what I call non-impulsive breakdown, for lack of a better word. You want to see a breakdown of any technical level, whether it's a chart pattern, horizontal support level, a trend line. You want to see impulsive buying if it's an upside breakout, so a big green candle, and impulsive selling on the downside, and that's not what we had here. So what happened this morning, we were down below that level, and so what I said, watch out for a back test, and two things I actually said. For a sell signal, watch out for a back test followed by an impulsive rejection, and that's what we had so far. Here's your back test, perfect back test right there, and the next candle, it actually goes that far. It's here, I have to really zoom in tight on this chart so you can see there, but look at the length of that candle. I mean, we managed to close the body back up here, but it had gone down that far, so that's what you call an impulsive move. And again, it came following the rejection off the trend line. What's a rejection? Well, when you have a back test, for example, right here we had this trend line here that was broken. We went down, we came in, back tested, followed by an impulsive rejection, and that led to this next leg down right here. So that's breakdown and back test. Sometimes you break down and that's it, you don't look back, and sometimes you break down and you have a back test. So far so good on that. And then I said watch these minor support levels there. You can see we've already taken out that minor support level. You can see why the line is there. There's a lot of reactions over the last few days, and so now that's taken out. So that opens the door up for that move down to, or a move down to that 75, 1950-ish target there, and then from there you just watch as it goes. If dip buyers can step in if you think the market's going to go to new highs, that would be an objective place to go long. Whereas short sellers, you had a chance on the breakdown or on the back test today. But again, you really want to see something on the daily charts. I'm going to get to those in a second here. We've had a lot of just intraday noise and grind back and forth. So let me put it this way. This is an early signal. If you want to take these, sooner or later the technicals will play out. One of these sell signals will stick and it'll be a big trade. Or you can wait for the daily chart to print something. I'll get to that in a second here, what I'm looking for. But so far so good, at least from this 60-minute chart. And again, I'm trying to put things into perspective, because a 60-minute breakdown is not as significant as a confirmed sell signal on the daily chart. And then of course the weekly chart's even more significant than that. But again, it was the positive, the negative divergences and everything else in place that said we'd probably get a breakdown. Now let's look at ES real quick. The S&P 500. So what happened there? Let's tighten up a little bit here. We had a breakdown as well, not very impulsive as you can see. Back test, back test. So we back tested there and we danced along, and we have been. So this is a level right now that I'm watching. This will be our next sell signal, or next rut row moment for the bulls, if that goes, at least here in the near term, because you can see a lot of nice clean reactions starting out early April. Here's the months down here, April 1st. So we had several reactions. We broke out, and we didn't just limp through. You can see the big green candle took us on the breakout. So that helps to confirm that level as a significant resistance level. The fact that we didn't just limp through it. So we broke out, back tested, stayed above it, back tested it again there, back tested again, little stick save right there. And so we've been dancing on it. So the more reactions you have on a support or resistance level, the more valid it is, the more technically significant. So as of now, we're above that level, and as I like to say, support is support until and unless broken. So although NQ is leading the way down right now, remember it's also coming up on its own support. And then to make this chart complete, let me give you a level right here. That's definitely a support level that if if SPY takes out this 2874-ish level that we're flirting with right now as I'm doing the video, we have a pretty significant support below at 2865. You can see again that's defined by this recent period of reactions there. That was support, as well as a significant reaction high right there. And again, 60-minute chart. So this is sort of near-term stuff. The daily chart takes precedence to everything that's happening here. But as of now, the most important thing is we had a rising wedge, complete with negative divergences. That wedge has broken down. We're really not going anywhere, but this will be it. This will be the next catalyst. So bears want to see that level get taken out. Bulls want to see it successfully defended. And I can tell you it's anybody's game at this point. So we'll just have to wait and see what happens here on these. Here's what QQQ looks like. This is a 1-minute chart. Just so you can see today's price action since that back test. You know, we had the run up. This is where the back test occurred, and then it's been a game of ping pong between the algos and kind of working its way down. Here's what we're watching right here. Here, let me pull that out to a 5-minute chart. I'll show that shows a little better. So here's a level to watch on QQQ that is certainly significant. It would be the top of the gap. This is Monday's gap. Was that yeah, we popped up on Tuesday, Wednesday's gap up. So you have a reaction high here. So give or take, we'll call it the 182.90-ish level. Certainly a significant level on QQQ right there to watch, because that is support from both the gap as well as that previous reaction high. Let's see the 60-minute charts. There it is. There's the breakdown back test of QQQ, and we're starting to move lower. Not really waterfall sell-off or anything like that yet, but again, it is a start. Now, QQQ is moving lower. SPY broke down, back tested, and has yet to take out yesterday's lows. So you could add this a similar line right here. I told you SPY is flirting on support right now, so that needs to go. And if that level goes, you can see some additional levels there. So we are below trend, at least these 60-minute trend lines. And again, it could certainly morph into something more, or maybe the market will just take it and gun it back up. I'm leaning towards this downside because of everything else, not just the living here in the world of the 60-minute charts, but also living in the world of the daily charts and the weekly charts as well. And again, negative divergence on the daily time frame, they're rare, and they often play out for the big turns in the market, just as bullish divergences do as well. So that's what we're watching, and let's just strip away all these lines and forget about all the support and resistance levels. What we're seeing here is price compression again. The prices are compressing, and from that often comes a big move. We'll see what happens, but it doesn't seem as close as we are to the highs. I figured by now this market would have made a run at those highs. It still can. So like I said, it's anybody's game. Let's just watch it. But keep one thing in mind, is that with little candles like this, it paves the way. You could have a big candle, a big bearish candle that can engulf a lot of those recent candles. Again, I've talked about that over and over again. Where we close the week, we've only got a day and a half left to do it, to close back above or back on or below that 282-ish level on SPY. So as of now, we're still comfortably above it. So at this point in time, bulls have the lead, and if they can build on those gains, and again, they're not too far from the highs. So let's just focus on what happens today and tomorrow, and if we kind of close where we're at now, certainly give a check mark to the bulls. But remember, as I said, with those divergences in place, doesn't matter to me if we go to new highs, if we close above 282 this week. Let's say we close right where we are, 286.30, 286.36. That certainly isn't where I'm going to go long because of what I'm seeing here with the divergences and everything else. I'll just continue to focus on other sectors, commodities, stocks that have very little correlation to the broad market, and just wait till I see my kind of setup, my comfort level with engaging the market long. Or short for that matter. May jump back into shorts depending on what happens in the next week or so here. Okay, you guys want to see something interesting, or at least I find it interesting. I've been watching bonds closely. I've talked about before it even happened, and now it is confirmed the potential divergences that were forming on TLT. So we had some cross currents there. We had a breakout of that key 122.50-ish level, very well defined support back here, then resistance for a while. Resistance minus one false breakout. A lot of resistance broke out. So that was bullish. But like I said, we had these divergences forming, and now they're almost confirmed. Any more downside now? You have the lower peak in the RSI, so let's just call it negative divergence right now. But we also have a big old gap that's being backfilled or about to be backfilled, and that should act as support. Plus 122.50 or so, we'll call it 123. It was significant resistance, and now resistance once broken becomes support. So keep that in mind for treasuries. Now, so it's cross currents. Like I said, the breakout in itself was bullish and still is as long as you remain above there. I'm not crazy about that divergent high right there. But let's talk on another related asset here. LQD. These are investment grade corporate bonds. So it's not junk bonds like your JNK or what's the other one? HYG. So those are your junk bonds. These are your investment grade quality corporate bonds. So what I see on this chart, well, you can see the annotations. Forget about the price support levels. I just want to leave those there for now. What stands out to me is you had a couple major inflection points. You had a divergent high right there at that point. There was a divergent high. There's your negative divergence down below. You can see your divergence lines. We had a small divergent low there, led to a rally and then a breakdown. So you can see technicals. I just wanted to highlight that technicals play out well to just about all asset classes. This is nothing to do with stocks. These are almost the opposite of stocks. These are bonds, and yet they, the same divergent highs and lows and trend line breaks and things like that. They work just as well here. So now, where am I going with this? Well, the corporate bond market, I've heard many very smart people in the industry talk of this as being one of the biggest bubbles right now out there in the markets, financial markets, corporate bond. There's been, because the Fed, kept the pedal on the metal they did way too much for way too long, in my opinion, and the opinion of most others, with the free money spigot. That's where this bubble in the stock market has come from, and the way that bubble, a big part of that bubble has been stock buybacks. Now, companies didn't repurchase their stock only with their earnings. They went out, borrowed money at next to nothing, and then juiced their stock prices up by borrowing at virtually very low rates via issuing the issuance of corporate debt bonds to go ahead and buy that stock back. Apple, for example, as you all know, is one of the most cash-rich companies in the world. They have more cash than they know what to do with than they always have, at least in recent years. They did a big bond issuance, and I don't know how many others, but they've issued bonds in recent years. Why? Because they could. If somebody came to you right now and said, you can borrow here. You can borrow $500,000, $1 million, and you can borrow that money at 2%, 1%. Most of you would, and you'd turn around, you put it in the stock market, you'd put it in real estate, you'd put it in the bank. You buy a CD at 3% if you can get it, make a little extra money. So that's what Apple did. Is they issued bonds and a lot of that money went to proceeds to buy their stock. So whatever, there's been a tremendous issuance in corporate bonds, and I'm not going to really speak to the bubble anymore on that part now. Let's just talk about the technicals. And this certainly is, I see a correlation here, a possible correlation with the stock market. So before we get into that, let's just see these divergent highs. So I see a couple of big important levels that are breakdowns that occurred in corporate bonds. You had the divergent high here. You had a trend line that goes to the left of the chart. And we had this very clear, unmistakable sideways trading range, right? That range broke down and started a very powerful sell-off once that happened. In fact, that sell-off didn't end all the way till it got down here. But it hit this level and we had a period of consolidation. There was a relief rally right there, right? And then This is sell signal number 2. So what I'm going to do here in a second is align these with the stock market. This one, probably the most, you can clearly see that. That was a shelf of support, breakdown. And then right here, we had a small divergent low. We had a rally. And then we broke down right here. In fact, we broke down, and more importantly, there was a support level right here. And this is where the next leg down started. So this was sort of like a consolidation period, and then another leg down in the market, right? Okay, so you probably see where I'm going with this because I mentioned the stock market, but if not, let's just talk about when that happened. This was in late January 2018, and so you had that leg down, the divergent low, bonds rallied, held support, and then broke down. An impulsive candle started the next leg down. When was that? Early October. So, okay, if you're not familiar, let's throw up a chart of the market and we'll compare here. We'll do a quick comparison. We'll take, instead of QQQ, we'll do SPY. There it is. And so now you can see, again, let's do it this way. There's the breakdown in bonds right there. There's the top of the market. That was one of the strongest rallies that we've ever had. Bubble was pricked back in late January 2018, last year. We had a sharp leg down followed by a second sharp leg down. So that was one of the biggest corrections in years right here. The white lines again on the S&P 500. And when did it happen? Right around the time corporate bonds broke down. So when did the October top happen? Remember, early October, the markets peaked before we had this, bloodbath in the last quarter, Q4. And you can see again we had that reprieve rally there. So corporates are rallying. The market was happy because bonds were going up, corporate bonds were going up, and stocks as well. And that's the other thing. I talked about the disconnect. Normally bonds and stocks move in opposite directions, and I spoke to that quite a bit back at the time. So what happened? Okay, once we broke trendline support, we had price support just below, as I mentioned. This is where bonds were hanging in there. LQD finally it gave up the ghost right here. Right at that point, wrong tool, grab that. There's the breakdown, and there's the initial leg down off the top, and the rest is history. We all know what happened. And then you can see here that bonds set up in a nice falling wedge pattern. So you can see the divergences I have marked below. So we had a divergent low. Bonds broke out in advance and started moving up. And I also mentioned we went long. We went long treasuries as the official trade idea. I pointed out LQD. I pointed out this bullish technical setup in LQD as well at the time, but just decided it's so similar, investment grade bonds and treasury bonds, which are of course investment grade as well. So we went with TLT, and I said that this positive correlation between bonds and just about all asset classes, it wouldn't last, especially if we had the meltdown, which we got. Then you saw everything turned around. You started to see a flight into safety, money moving out of stocks into bonds. So point is that corporate bonds bottomed first, and right towards after they started to rally, they had a little sharp leg down in the melt-off phase there where everything was getting sold. But you can see they continued on trend. They kept making higher lows, and they were in an uptrend since. All right, so where do we go with that? Let's just get rid of the comparison chart, get rid of the overlay. And again, it speaks to the technical outlook for bonds right now, at least corporate bonds. You have that divergent high right there. Divergence on the RSI as well, negative divergence. So if this plays out, then one would expect that's not going to be good for the stock market. So what are the levels to watch? Well, this 119.68 level, that's still an important level. I'd put almost coin toss odds if we're going to make it up there. Treasuries just came back. Look, and corporates too. I just showed you treasuries a minute ago. Here's a big gap right here. So we'll probably get a bounce off that gap. And it may come all the way up here. I'll tell you, it would be an ideal scenario to see us get all the way up here on corporate bonds, LQD, to about that 119.68 because it was such a well-defined level and even made more technically significant by the fact we had a waterfall type sell-off or a big impulsive move down after the breakdown. So there is scenario number one. We kick back up here. The divergences would only be extended at that point, most likely, based on where the posture of the indicators right now. In other words, if we go like this, extend the lines out. Here, let me do it this way, clear out everything else. Extend the divergence lines like this, and assume a thrust up and then a reversal and a break of the trend line, which by the way would be a pretty powerful sell signal, and that could look something like this, and give us just a simple extension of the divergent high. However, we do have a divergent high in place, so we don't have to have that. It is one scenario. Let's watch, see how this gap is handled, and then below the gap you have this potential uptrend line here, and then I can tell you 116.55 is very, very important support. It's a pretty significant level on LQD right there. So if these divergences play out, look for that to come in as potential support. Okay, I was going to wrap it up there, but I just wanted to speak to junk bonds, because here's the thing. I think, this is just my theory, I think too many eyes are watching this. I've told you for many years now, and I've shared it over the years. I'll go to Fred's site, Federal Reserve, I'll and check credit spreads. You know, that's the differential between junk bonds and investment grade, or treasuries actually. That's what the spread is between treasury bonds and high yield. But you can also watch, if you don't want to pull up credit spreads, you can watch JNK or HYG. Those are your junk bond ETFs. And now make no mistake about it, they are in a bear market. Here's let's go back here. Well, yeah, this is a weekly chart. So JNK topped back here, and keep in mind it pays dividends as well. But this thing topped back in 2013, early 2013, and we're still 15% or so below it. So what does that tell you about the economy in junk bonds? It tells you something there. This thing isn't even close to new highs like the stock market. So don't get me wrong there. However, it's the recent price action. It's really holding up, tracking, almost dollar to dollar to equities. So this is one of two things. I can tell you this. It's showing complacency in the high yield market. Now, I don't know what kind of dynamics have gone on there in the last few years. I know a lot of the high yield, the bonds in JNK and the high yield market in general, a lot of those are energy stocks, and we know oil's been rallying, so that's put a bid underneath a lot of energy stocks, so that certainly helps JNK. But I think this could prove to be a false signal. If people are waiting to see junk bonds roll over first to show a red flag to the stock market. I don't know. Like I said, I just showed you that maybe we should be watching the corporate bond market right now for those reasons I just showed you before. This is certainly one to keep an eye on. And again, like I said, longer term, this thing is in a downtrend, but recently, there's mixed technicals, just like the stock market. We had a nice downtrend line here. You can see I've drawn that downtrend line. We broke above it, back tested, and that in itself is bullish. So you might say, okay, well, breakout back test of a major trend line, that's very bullish, which it is, but the cross currents are, and there's always a but, isn't there, with technical analysis. $36 is pretty significant resistance, as you can see. I have my next resistance up here around 36.26. So we failed recently at resistance, and like the stock market, for the first time in a long time, we have negative divergence on the PPO and RSI. So therefore, I'm a little skeptical of how far this breakout might go. Now, if these divergences get taken out, by the PPO moving on up past those previous highs, same with the RSI, there's certainly some potential there for junk bonds to continue to rally. But as of now, like I said, there's what I call technical cross currents, and one thing I can say with certainty, now I can't tell you which way this goes with certainty, but I can tell you we're at a significant technical level or crossroads, and I think where the next 10% or so in the market, stock market as well as junk bonds is, whether it's to the upside or downside, it certainly has the impact to change the technicals. Either get rid of these divergences, break out the S&P 500 to new highs, or we reverse here and then the divergences play out, and then that could even lead to more downside. So we'll continue to watch things again this week. Day and a half left to go. As of now, it looks like the markets are going to close, or the SPY will close above that 282 level on the weekly chart. But as I said, a lot can happen in 1 day, 1.5 days in the market, especially lately because we've had very small candles. We have almost two dojis on SPY. Let's see, QQQ, I think we put in. Yeah, there it is. We had a doji yesterday. So far, a red candle today. Small candles recently. So here, let me try to put my thoughts into words here. All right, so here's what a big candle looks like. These are single day candles. You add one of those candles, let's say tomorrow, and that's taken us right back down below 182. So it's very possible. It hasn't happened yet. If it does, then we'll go from there. I'm going to wrap it up here. This has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.